Hello, and thank you for joining us for this World Council of Credit Unions virtual event, The Rise of Bitcoin ETFs and Their Impact on Cryptocurrency Exchanges. I'm Greg Newman, Director of Communications for World Council. Before we get started, please take a moment to click on the interpretation button at the bottom of your screen and choose your language, English or Spanish, to make sure you can hear all of today's presentation in your preferred language. Tómese un momento para hacer clic en interpretación y elija su idioma, inglés o español, o para asegurarse de que puede escuchar esta reunión en su idioma preferido. The emergence of Bitcoin ETFs is transforming the financial landscape, and credit unions are uniquely positioned to adapt to this shift. These investment vehicles are driving changes in member expectations, market activity, and regulatory frameworks. Today, Nikhil Jarunde, Finance Project Manager for the Depository Trust and Clearing Corporation, will explore how Bitcoin ETFs are shaping the future of financial services and what it means for credit unions striving to meet the evolving needs of their members. If any questions come to your mind during today's webinar, please use the Q&A button at the bottom of your screen and type them in there. I'll ask them of Nikhil at the end of this presentation as time allows. Today's webinar is being recorded and it will be available for viewing later today on the World Council YouTube channel. And now, without further ado, I am happy to welcome in Nikhil, who will take you through today's presentation. Nikhil, thanks for being here, and the floor is yours.
Thank you, Greg, for the introduction. So welcome everyone, and thank you for joining this webinar on the rise of Bitcoin exchange-traded funds, or ETFs, and their impact on existing cryptocurrency exchanges. So in this session, we will explore how Bitcoin ETFs are shaping the future of financial services and what it means for credit unions striving to meet the evolving needs of their members. The key takeaways that we will be covering is understanding the fundamentals of Bitcoin ETFs and their role in modern financial markets, exploring the potential impact of Bitcoin ETFs on credit union operations and member services, learning how credit unions can navigate the regulatory environment surrounding cryptocurrency, and discovering strategies to stay competitive and relevant in the age of digital assets. So since Bitcoin's inception in 2009, the cryptocurrency market has experienced remarkable growth and volatility. In recent years, the emergence of Bitcoin exchange-traded funds, or ETFs, has presented a new avenue for investors to gain exposure to Bitcoin without directly owning the cryptocurrency itself. These ETFs, which track the price of Bitcoin and trade on traditional stock exchanges, have the potential to significantly impact the existing cryptocurrency exchange landscape. One of the primary concerns surrounding the rise of Bitcoin ETFs is their potential to draw liquidity away from direct Bitcoin exchanges. As ETFs offer a more accessible and regulated investment option, they may attract investors who were previously hesitant to engage with the complexities of cryptocurrency exchanges. This shift in liquidity could have far-reaching implications for the trading volumes and overall activity on direct Bitcoin exchanges. Furthermore, the introduction of Bitcoin ETFs is expected to pave the way for increased institutional investment in the cryptocurrency market. Institutional investors who have traditionally been cautious about venturing into the unregulated and volatile world of cryptocurrencies may find ETFs a more familiar and palatable investment vehicle. The potential influx of institutional capital could have a transformative impact on the cryptocurrency market, bringing increased stability, legitimacy, and mainstream adoption. So this presentation investigates the complex relationship between Bitcoin ETFs and existing cryptocurrency exchanges by examining the mechanisms through which ETFs may draw liquidity away from direct exchanges and analyzing the factors contributing to increased institutional investment. This study seeks to provide valuable insights into the evolving landscape of cryptocurrency trading. The findings of this presentation will be of interest to investors, regulators, and market participants alike as they navigate the rapidly changing world of digital assets. So Bitcoin was introduced in 2008, white paper titled Bitcoin, a peer-to-peer electronic cash system by an individual or group of individuals using the pseudonym Satoshi Nakamoto. The paper proposed a digital a decentralized digital currency that could operate without the oversight of a central authority, primarily to enable direct transactions between parties without the need for trusted third-party intermediaries like banks. The first Bitcoin transaction took place between Satoshi Nakamoto and an early adopter named Hal Finney in 2009. Initially, Bitcoin was used primarily within the tech and cryptography enthusiast circles, and its first notable commercial transaction was the purchase of two pizzas for 10,000 Bitcoins in 2010. Over the years, Bitcoin gained popularity and its value surged, especially during notable bull runs in 2013 and 2017. These periods, they saw Bitcoin's transformation from an obscure digital token to a serious financial asset, attracting attention from both individual and institutional investors. Its acceptance for payments by various merchants and the increasing interest from mainstream financial sectors also marked significant milestones in its evolution. So one of the core characteristics of cryptocurrencies like Bitcoin is their decentralized nature. Unlike traditional currencies, which are issued and regulated by central authorities such as a government or a central bank, cryptocurrencies operate on a decentralized network of computers or nodes. This decentralization is facilitated by blockchain technology, which ensures that no single entity has control over the entire network. At the heart of cryptocurrency technology is the blockchain, which is a distributed ledger that records all the transactions across a network of computers. Uh, so blockchain technology basically ensures transparency and immutability of records, making the transactions secure and resistant to fraud. Each transaction is verified by a network of nodes through a process called as mining, and once confirmed, it's added to a block in the chain. Cryptocurrencies can be traded on various online platforms known as exchanges. These platforms they match buyers with the sellers, similar to traditional stock exchanges. Cryptocurrency owners can also store their digital assets in digital wallets, which come in various forms, such as software wallets or hardware wallets and paper wallets. And each wallet type offered different levels of security and convenience depending on the user's needs. Cryptocurrency also offer enhanced security features due to cryptographic protocols used in transaction processing and the decentralized ledger system. Additionally, privacy can vary significantly across different cryptocurrencies. For example, Bitcoin transactions are they are pseudonymous, but they can be traced. They are traceable. Whereas other cryptocurrencies like Monero, they provide more robust privacy protections. An exchange traded fund basically is a type of investment fund that tracks an index or commodity bonds or basket of assets, like an index fund, but it trades like a stock on an exchange. ETFs experience price changes throughout the day as they are bought and sold, which provides liquidity and flexibility to the investors. ETFs are managed by professional investment managers who adjust the fund's holdings to match the target index or assets as closely as possible. Investors in an ETF own a portion of the ETF, but they do not own the underlying asset directly. This allows the investors to diversify their portfolios without the need for significant capital or direct ownership of a large variety of stocks or assets. The journey towards the approval of Bitcoin ETFs was a lengthy one, characterized by like multiple rejections due to concerns about market manipulation and volatility. 10 years after the spot Bitcoin ETF application was filed in the US, the Securities and Exchange Commission, or the SEC, finally approved spot Bitcoin ETFs on January 10th, 2024. However, in 2024, the US SEC approved the first spot Bitcoin ETFs, marking a significant regulatory milestone. This followed earlier approvals in other countries like Canada and Brazil, which had already introduced such products to their markets. So there are coming to the types of Bitcoin ETFs. So there are two types of Bitcoin ETFs: spot Bitcoin ETFs and Bitcoin futures-based ETFs. So spot Bitcoin ETFs, these funds they directly purchase Bitcoin, allowing the ETF to track the price movements of Bitcoin itself. This type was recently approved in the US after years of scrutiny. And the second is Bitcoin futures-based ETFs. So unlike ETFs, these funds they invest in futures contracts for Bitcoin rather than holding the cryptocurrency directly. Futures-based ETFs were the first type of Bitcoin-related ETFs approved by the SEC and are intended to provide exposure to Bitcoin's price movements without the challenges of managing actual Bitcoins. next, coming to the advantages and challenges of Bitcoin ETFs. So the advantages include like Bitcoin ETFs simplify the process of investing in Bitcoin. Right, investors can buy ETF shares through traditional brokerage accounts, avoiding the complexities of cryptocurrency exchanges or digital wallets and private key management. ETFs are regulated investment products offering a layer of security and oversight that is absent in the broader cryptocurrency market. So, this can help to attract more conservative investors and institutional money into Bitcoin. Investing in Bitcoin through an ETF can offer tax advantages compared to buying and selling Bitcoin directly, especially regarding capital gains taxes and estate planning. And coming to the challenges, so despite recent approvals, Bitcoin ETFs have faced significant regulatory challenges. Concerns remain about market manipulation, Bitcoin's inherent volatility, and the liquidity of underlying markets. So there's an ongoing debate about the impact of Bitcoin ETFs on Bitcoin's price volatility. While some argue that increased institutional participation could stabilize the prices, others fear that it might lead to increased speculation and price swings. Investors in Bitcoin ETFs, they do not own the Bitcoin directly. This means that they miss out on some benefits, such as choosing how to use or spend Bitcoin, and they rely heavily on the fund's management to accurately track the Bitcoin's prices. So next, we talk about the impact on cryptocurrency exchanges. First is liquidity dynamics. So Bitcoin ETFs could potentially affect the liquidity of direct cryptocurrency exchanges by diverting funds that would otherwise have been traded directly on these platforms. The introduction of ETFs provides a more accessible investment route for individuals and institutions, wary of the technical challenges and security concerns associated with traditional cryptocurrency exchanges. A review of existing financial literature indicates that when similar financial instruments are introduced in other markets, they tend to attract liquidity from less regulated or more complex markets to more regulated markets. For example, the introduction of gold ETFs had led to significant shifts in how individual and institutional investors access the gold markets, pulling substantial interest away from direct commodity purchases and futures contracts to the more accessible ETFs. For cryptocurrency exchanges, this could mean a decrease in trading volumes, which might impact fee revenues. However, the overall effect on the market could be nuanced. While some liquidity might move to ETFs, these funds could also bring in new investors who might not have participated earlier in the market at all without the availability of a regulated ETF option. The next is institutional versus retail investment. So Bitcoin ETFs are likely to catalyze a significant shift in the investor base of Bitcoin from predominantly retail to a more balanced mix with increased institutional participation. Institutional investors often prefer products that offer regulatory safeguards, transparency, and ease of access, the attributes that ETFs do provide. Then, coming to the broader impact, so increased institutional involvement can lead to greater market stability and maturity. Institutions are generally seen as more conservative investors with a longer term focus, which might reduce the volatility associated with predominantly retail driven crypto markets. On the flip side, the democratization of access through ETFs allow retail investors who might be intimidated by the complexity of crypto wallets and exchanges to enter the market. So this could increase the retail investor base, albeit through a more regulated and possibly less volatile form of investment. So talking about institutional investment in cryptocurrency, we'll talk about the emergence of Bitcoin ETFs, shifting institutional perception, regulatory uncertainty and volatility, addressing institutional needs, and catalyzing institutional capital. So first talking about the trends in institutional investment, initially institutional investors were quite hesitant to engage with the cryptocurrencies due to the volatility, also lack of regulatory clarity and the nascent nature of the technology. But over time, the perception of cryptocurrencies has shifted significantly. So major milestones such as the launch of Bitcoin futures on major exchanges like the CME and the gradual entry of established financial institutions into crypto services have marked key turning points like BlackRock. More recently, the narrative around cryptocurrencies has evolved with a growing recognition of the potential as both an investment class and a hedge against inflation. This shift was particularly noted during the COVID-19 pandemic, which accelerated the digital transformation and highlighted the potential of digital assets. Institutions like hedge funds, family offices, and even pension funds have begun to allocate portions of their portfolios to cryptocurrencies, significant signaling a significant shift in sentiment. Coming to the barriers to institutional entry, so one of the primary barriers for institutional investors have been the uncertain regulatory environment surrounding cryptocurrencies, the lack of clear guidelines, and the potential for regulatory penalties have made many institutions wary of significant investments in this asset class. The high volatility of cryptocurrencies, coupled with issues such as potential market manipulation, lack of liquidity at scale, and the risk of cyber theft, has also been a major concern for institutional investors. Traditional institutions often face operational challenges when entering the cryptocurrency market. These include the need for secure custody solutions, reliable liquidity providers, and tools for risk management, which until recently were not as developed in the cryptocurrency space as in traditional financial markets. Coming to the role of Bitcoin ETFs in attracting institutional investors, so Bitcoin ETFs address several of these barriers and they have historically deterred institutional investors. By, by offering a more regulated, familiar investment vehicle, ETFs reduce the operational risk of holding and securing cryptocurrencies directly. ETFs are subject to to stringent regulatory standards, providing a level of security and compliance comfort that is crucial for institutional participation. They also offer a way to invest in Bitcoin within a framework that meets institutional investment criteria, complete with risk management and liquidity provisions as well. The introduction of gold ETFs in the early 2000s provided a helpful analogy. This ETFs transformed gold investing significantly in increasing institutional exposure to gold. They offered a direct, liquid, and less cumbersome investment option compared to physical gold. Similarly, Bitcoin ETFs are expected to streamline the process of crypto investments, making them more accessible and attractive to large-scale investors. Now, talking about implications for credit unions. So this slide focuses on how the rise of Bitcoin ETFs impacts credit unions and their members, emphasizing both opportunities and challenges. As cryptocurrency investments become more mainstream, credit unions are increasingly likely to encounter members seeking exposure to digital assets. So let's explore the key areas of implication. So first, talking about members who are seeking crypto investments. So with Bitcoin ETFs offering a regulated pathway to cryptocurrency investment, members who were previously hesitant about digital assets due to security and complexity concerns may now express interest. Credit unions must be prepared to address these evolving member needs, offering education on the benefits and the risks of Bitcoin ETFs and other cryptocurrency products. Second, regulatory compliance challenges. So cryptocurrency landscape is highly dynamic and regulated differently across jurisdictions. Credit unions need to navigate evolving requirements to remain compliant while exploring opportunities in this space. Proactively engaging with regulatory authorities like the National Credit Union Administration or the NCUA and FinCEN can help to clarify compliance expectations. Operational readiness for crypto services. So to meet member demand, crypto unions must assess their operational capabilities. This includes updating systems to support cryptocurrency transactions, ensuring cybersecurity measures are robust, and training staff to manage crypto-related queries effectively. Offering Bitcoin ETFs might require partnerships with financial institutions already involved in the cryptocurrency space. Potential for market disruption. Adoption of Bitcoin ETFs could disrupt traditional financial services, including savings and investment products. Credit unions may need to rethink their product offerings to stay competitive in the face of changing member preferences. Additionally, they should explore ways to integrate cryptocurrency products into their portfolios without compromising financial stability. This credit unions can position themselves as forward-thinking institutions that meet modern financial needs of their members while managing associated risks appropriately. So the main benefits include like diversification, because credit unions they traditionally hold conservative investment portfolios, primarily consisting of low-risk assets like government bonds and mortgage-backed securities. So the Bitcoin ETFs could provide exposure to an emerging asset class, enhancing portfolio diversification. So diversification also helps in spreading risk across different types of investments, reducing dependency on traditional asset classes. Then the next benefit I would discuss is the potential for higher returns. So Bitcoin and other cryptocurrencies, they have historically shown a high growth potential, albeit with significant volatility. Bitcoin ETFs would allow credit unions to gain exposure to this potential upside without directly holding or managing cryptocurrencies. So, and such investments could bolster the overall performance of the credit union investment portfolio, increasing earnings, which would then be translated to better rates for the members, like low rates on loan and high rates on savings. The next benefit I would talk about is attracting young members. So Bitcoin and cryptocurrency investments, they resonate particularly with younger demographics who are more likely to be interested in digital assets like tech-savvy members. So by offering investment-related services or options linked to Bitcoin ETFs, credit unions can attract tech-savvy members and increase member engagement. So this can also enhance member acquisition and retention, ensuring long-term growth. The next benefit that I would say is competitive edge. So as financial institutions, particularly banks, begin to explore cryptocurrencies and related products, credit unions risk falling behind. So incorporating Bitcoin ETFs as part of the investment or service offering demonstrates innovation and adaptability, keeping credit unions competitive in the financial services landscape. And then the few other benefits could be income generation, hedge against inflation, and simplified crypto exposure. The risks also include the risk. Mainly, first is the volatility risk. So Bitcoin is like highly volatile and its value can fluctuate dramatically, which could adversely affect the credit union's portfolio. Second is regulatory uncertainty. So cryptocurrency still face evolving regulations and changes in policies that could impact the performance of the availability of Bitcoin ETFs. Reputational risk. Exposure to cryptocurrencies might be viewed as speculative by conservative members, potentially impacting trust. Then liquidity risk. During market downturns, liquidity challenges might arise if the ETFs fail to maintain adequate reserves or experience significant sell-offs. So, yeah, the next we talk about navigating the regulatory environment. So the regulatory framework for Bitcoin ETFs and cryptocurrency remains complex and fragmented across different jurisdictions. And in the US, particularly, the SEC's recent approval of Bitcoin spot ETFs marks a significant step forward, reflecting a more accommodating stance towards cryptocurrency-related investment products. Moving forward, regulatory developments are likely to focus on enhancing consumer protection, ensuring market integrity, and addressing the systemic risk associated with the crypto market. We might see more comprehensive guidelines around the use of cryptocurrencies and associated financial products, which could pave the way for more widespread adoption and integration into traditional financial systems. The analysts and industry experts, they generally agree that the introduction of Bitcoin ETFs could lead to increased institutional investment, potentially stabilizing and maturing the cryptocurrency market. This could mitigate some extreme volatility historically associated with cryptocurrencies. With the potential influx of institutional money, the overall market cap of cryptocurrencies could see substantial growth. Additionally, legitimization effect of regulatory approval could encourage more conservative players like pension funds and insurance companies to enter the market. Bitcoin ETFs and broader cryptocurrency adoption could influence global financial markets by introducing a new asset class that competes with traditional assets such as gold and equities. This might lead to revaluation of asset allocation strategies by large financial institutions and asset managers. As cryptocurrencies become more integrated into the financial system, central banks may consider the implications for monetary policy. Cryptocurrencies could affect the control that the central banks have over the money supply and interest rates, especially if they become a significant medium for daily transactions. The increasing integration of cryptocurrencies into the financial landscape possess both opportunities as well as risks. While they offer the potential for enhanced financial inclusion and democratization of finance, their volatile nature and the evolving regulatory landscape could pose challenges to economic stability. Coming to conclusion, so, in conclusion, the introduction of Bitcoin ETFs represents a transformative milestone in the evolution of cryptocurrency investment, providing a bridge between the traditional financial sector and the burgeoning world of digital assets. So, this presentation had explored the multifaceted impact of Bitcoin ETFs, particularly in terms of liquidity dynamics on cryptocurrency exchanges, the shifting balance between traditional, institutional, and retail investment, and the broader implications for financial markets and regulatory frameworks. So our analysis highlighted that Bitcoin ETFs could potentially reallocate liquidity, drawing it away from traditional cryptocurrency exchanges and reducing their trading volumes. However, they also lower barriers to entry, offering a simpler regulated means for investors to gain exposure to Bitcoin. So this could broaden the investor base, integrating more institutional capital and possibly stabilizing the notoriously volatile cryptocurrency market. Moreover, the regulatory landscape for cryptocurrencies and their ETFs continue to evolve, with recent approvals indicating a more receptive stance towards these digital assets. As the regulations mature and provide more explicit frameworks, the market is likely to see increased participation from conservative institutional investors, further embedding cryptocurrencies within the global financial system. While Bitcoin ETFs bring several advantages like enhanced accessibility and regulatory oversight, they also introduce new challenges and considerations, especially in terms of market impact and regulatory compliance. As this financial innovation continues to unfold, it will be crucial for stakeholders to navigate these dynamics carefully, ensuring that the growth of cryptocurrency investments contributes positively to the broader objectives of market stability and economic resilience. And this ongoing evolution will undoubtedly offer fertile ground for future research and policy development as digital assets become an increasingly mainstream component of the global financial landscape. Lastly, investing in Bitcoin ETFs could help credit unions diversify their portfolio, attract younger members, and stay competitive in an evolving financial landscape. However, the decision to invest in Bitcoin ETFs should be guided by a clear responsible strategy, member interest, and alignment with the credit union's overall mission and regulatory framework. I thank you all for listening to the presentation. I'll take the questions.
Yeah, Nikhil, thank you so much. I think you've given everybody on the webinar a lot to think about. And I think the one thing that I've seen so far in the questions and that came to my mind as well relates to the issue of regulation and supervision, because this is a new area. I know some governments and some regulators have been out front on crypto and others are way behind. And so I think that it would be interesting, I think, for me to hear, do you know of either countries or regions of the world where the regulators are a little bit further ahead on crypto when it comes to at least financial investments of institutions like credit unions versus maybe some other areas of the world?
Yeah, like the issue and of regulation and supervision are particularly critical for credit unions to operate within the legal framework and manage risk effectively. So, I mean, here's how So particularly, I would say that engaging with regulatory authorities would be key, like building strong relationships with the national and local regulators to understand the requirements for the Bitcoin ETF investments. They're participating in industry associations or advocacy groups that engage with policymakers to shape cryptocurrency investments would be important as well. So regions where I would say that in the US, like SEC, overseas securities, including Bitcoin ETFs, while Commodity Futures Trading Commission or CFTC, it regulates Bitcoin futures. The US is a leader in Bitcoin ETF approvals, such as the ProShares Bitcoin Strategy ETF or BITO, which invest in Bitcoin futures. Then there are some state level regulatory frameworks as well, like New York's, I think it's called New York's Bit License. It established clear rules for cryptocurrency businesses. So these are the leaders in that, and I think definitely they are ahead. These regions where the regulations are pretty like stringent and well applied. In the European Union, I remember there was something called MICA or Markets in Crypto Asset Regulation. So this is a comprehensive framework for regulating cryptocurrencies. And this already took effect last year in 2024. So basically, MICA provides a unified set of rules across EU member states, enhancing clarity and reducing regulatory fragmentation. Then US, Europe, yeah, and then in Canada, Canada was one of the first countries to approve Bitcoin ETFs. There's something called purpose Bitcoin ETFs under the supervision of securities commissions. So I think these frameworks are pretty much transparent, making Canada an attractive market as well for crypto-created investments. Then even in Singapore, there's something called, if I'm not wrong, MAS, Monetary Authority of Singapore. Then Australia has similar one. Then Switzerland. So I think to address regulation in general, uh, the credit unions must engage proactively with regulators, comply with existing laws, and implement strong internal frameworks. So regions like US, EU, Canada, and Singapore in general are much ahead in establishing like robust cryptocurrency regulations, offering valuable models for navigating regulatory challenges.
Yeah, of course, here in the U.S., we've seen with our new President Trump, he has really embraced cryptocurrency and is promoting its use far more than we've seen before. Some questions from our audience here. Habiba wants to know, in your view, in relation to the awareness and involvement at a glimpse, what is Bitcoin's impact in developing countries? Which sectors of the economy in maybe some of the developing countries would you say have a good grip of the concept of Bitcoin or cryptocurrency?
A good question. So in so the impact of Bitcoin in developing countries would be like first of all would be like financial inclusion, access for the unbanked. Like millions in developing countries, they lack access to traditional banking systems due to infrastructure or LGBT barriers. So Bitcoin, since it doesn't involve a central authority, it enables participation in the global financial system with only a smartphone and internet connection. Secondly, like cross-border payments, Bitcoin simplifies remittances, allowing expatriates to send money home without relying on expensive like third-party intermediaries like banks. So yeah, so it simplifies cross-border payments. Then talking about in emerging markets, yeah, like currency devaluation, it's a hedge against inflation in countries with volatile or hyperinflated currencies like Venezuela or Zimbabwe. Bitcoin offers a relatively stable source of value. The citizens over there can use Bitcoin to protect their wealth from the devaluation of the national currency. Then I would say reduction in transaction costs. Traditional cross-border payments often come with higher fees and like foreign exchange rates and slow processing times as well. So Bitcoin reduces this cost and enhances faster transactions, benefiting businesses and individuals. Then next benefit, I would say, the next impact I would say in developing countries is empowering entrepreneurship. Bitcoin facilitates global commerce for smaller businesses and freelancers in developing nations by providing direct access to international markets. Then one of the most important features is transparency and security. Bitcoin's blockchain, obviously, it ensures transparency in transactions, which can help reduce corruption in regions where financial fraud is quite prevalent. So in general, I would say the impact is very, very like positive, and I'm sure it will take a global stage in the future.
Another question comes from Dennis. He says, in the context of enhanced regulation and supervision of credit unions, how could Bitcoins become a business product acceptable to all stakeholders? You mentioned youth, young people, that they're interested in it. It's a way to attract them. But when you're talking about people my age, perhaps, or even older, there's a lot of reticence. I know my sister thinks I'm crazy for having any Bitcoin investment. So how do you make it palatable to all stakeholders, would you say?
To all stakeholders. So I mentioned that Bitcoin ETFs, obviously, they are attracting younger members, like more tech-savvy members. But I would say that in general, it's a product that could be used for by all the stakeholders, including the conservative members as well. Because as I mentioned, like Bitcoin ETFs offer a product which is more regulated, unlike the data cryptocurrency markets. Also, through Bitcoin ETFs, you do not directly own the Bitcoin, right? But you own a portion, I mean, it trade like a stock. So the risk of like fraud or getting your wallet stolen is obviously minimized. So that's how it attract all the stakeholders. And mainly, as I mentioned, like traditionally, the credit unions have always invested in low risk assets like government bonds or mortgage-backed securities. So this new asset class provides a way to diversify the investment. It's a more risky, but like maybe they can allocate a small portion of the money in this industry. So I think this offers a good way to diversify the investment, and also like potentially more returns, and more returns obviously would translate, like credit unions are not for profit now, but the profit from the investment of the Bitcoin ETFs could translate to like better rates for the members going forward, like offering lower rates for loans or higher rates for the savings than they used to be. So I think it's a good strategy for all the stakeholders in general. So yeah, I would say that.
Uh, yeah, and you mentioned, I mean, we obviously know credit unions. This is an issue that comes up just about every webinar we host now, is the fact that the aging membership is not sustainable. In most countries, membership is over the age of 45 on average. In North America, it's over the age of 50. So this is obviously a way to attract young members. What have you seen? I mean, I only know anecdotally young people are interested in cryptocurrency, but do you have any? I don't want you to have to quote statistics, but is there a lot of evidence that shows indeed they are interested, and that would be something that would drive them to perhaps invest?
You mean the young
The
members
avail the
coming to
avail
cryptocurrency markets?
Correct, yeah.
Yeah, I mean, and from my personal experience, like interacting with a lot of younger members, like coming out of straight off colleges, almost like 70% of the people that I come across, they have exposure to cryptocurrency markets. So I know that there's a lot of like craze among the younger generation to invest in crypto, and I think the volatility, they like the returns on it. So I think it's still evolving trend among the younger generation. But as more awareness becomes available, like this is going to like get even more popular among the younger generation. But as of now, like as the people that I interact with in general, the younger the crowd is more into cryptocurrency space. So
I don't have any final questions from our audience, Nikhil. I first just want to thank you so much. Actually, we do have one that just came in. Colleen asks, are there any studies that you know of on the uptake of Bitcoin and other cryptocurrencies in the Caribbean?
can you repeat the question again? In the Caribbean?
Sure. Are there any studies on the uptake, on the use of Bitcoin or other cryptocurrencies in the Caribbean?
Okay, Caribbean. Let me think about that.
And that might be
So yeah, I
something that,
mean,
yeah, go ahead.
Yeah, I think so. The Bitcoin adoption in the Caribbean has been steadily increasing as well. They are mainly influenced by factors such as financial inclusion, as I mentioned, remittances, and economic diversification. In terms of adoption, um, I know some countries like Haiti, almost 1% of the population are cryptocurrency users. Similarly, in Jamaica and Puerto Rico. And the regulatory environment is such that in the Bahamas, it pioneered the introduction of a central bank digital currency, CBDC, with the cent dollar in 2020 during COVID. So it aimed to enhance financial inclusion and payment system resilience. Then even in Jamaica, there's something called ECCU, which made significant strides in introducing CBDCs to improve financial systems. So the economic implication is that, like the Caribbean region, it benefits from cryptocurrency. By facilitating easier and more cost-effective international transactions. Um, yeah, the I mean,
And I,
and the in terms of the challenges, yeah, sorry.
no, go ahead.
In terms of like challenges, I would say that the varying the legal status of cryptocurrency across different Caribbean nations can create challenges for widespread adoption. Like while some banks or some regions have developed the infrastructure, others may lack the necessary technological framework to support cryptocurrency transactions effectively. So it'll be interesting to see like how it goes in future. In general, like Caribbean is experiencing a gradual increase in adoption, but the extent of adoption varies across the region. The influence by local regulations and infrastructure development.
Yeah, I think that every person who sees this is probably going to recommend that somebody else view it as well. And if you have questions that come to your mind later, please feel free to email communications@woku.org. That's communications@woku.org, and we'll get them to Nikhil. And if it's a question that maybe you think of in a couple of days, we can make sure that he gets the email from you and can perhaps answer that question. But we don't have any more questions right now, Nikhil. I really appreciate your time. I think this was pretty eye-opening for a lot of people who tuned in today. And definitely want to thank you for your time because I know you're probably a very busy guy.
No, it's my pleasure, and I really love to interact on this topic. And I know this is an emerging trend, and a lot of like studies and regulations and work on regulations would like come through as the Trump administration has taken over recently. So I think this is very exciting new phase, and yeah, I look forward to see all the developments coming.
All right. Thank you so much again. If you like this webinar and you want to watch it again, or you'd like others to see it, you can refer them to the World Council YouTube channel at youtube.com/Woku. It will be available there later today. And if you want to participate in other great educational sessions in person, we're happy to let you know registration for the 2025 World Credit Union Conference is open. World Council will be hosting the 20th anniversary of the premier global credit union event in beautiful Stockholm, Sweden this year from July 14th to the 16th under the theme, The Future is Cooperative. Simply scan the QR code on your screen right now to register. If you don't have your phone handy, you can just head to wcuc.org. Cassie put it in the chat there to learn more and then register for what promises to be a historic event. We would love to see all of you there next summer. That's it for today's webinar. Thanks for joining us, everybody. Have a great rest of your day.